All right, so this is going to be the February community call for Unveiled. And the theme for this month is we're just going to go over an overview of the entire curriculum. We're going to learn how to properly blend ICT concepts and see how all of the curriculum blends together. So let's go ahead and get started. All right, so the art of studying algorithmic theory. So ICT concepts aren't just a technical method, they are a language or a puzzle where everything fits together. And ICT concepts are a language that was created to describe how the financial markets are efficiently delivered. And in order to describe something that is efficiently delivered, the language used to describe them also has to be efficiently delivered. All right, let me let Deontay in as well. All right, so basically what I'm trying to say with this is that because the financial markets are efficiently delivered, the way that ICT describes, how the markets book, that's also going to help us be able to blend a lot of the concepts together. So if you understand, just like the subtle nature of the language that he uses, it's going to help you, bridge together a lot of the different concepts within algorithmic theory. And then you'll see how I apply all of this as we move on through the rest of this lecture. All right, so first we're going to start off with the anatomy of a candlestick. So this is going to be for the guys that are newer. So basically a bullish candle is going to have that open, high, low, and then it's going to close higher than it opens, right? So this is that bullish candle. And then the main reference points here are going to be the open, and then it's going to be the low, the high, and then the close over here. And then same thing with this candle over here, this bearish candle. So this is going to be the high. This is going to be the open. This is the close. And this right here is the low. So where we get the most value out of understanding the anatomy of a candle is when it shows up on a higher time frame. So a candle is not a candle without the delivery that makes it a candle. So on a higher time frame, so let's say that this was a daily or a monthly, then there's a certain delivery that's taking place that forms this candle. So as price is forming this candle, price is going to go open, it's going to go high, and then low, and then close. So if we're an intraday trader, we can get involved maybe somewhere over here or somewhere over here, and then ride this formation of this candle. And same thing over here. So the way that this candle is forming, if this were a higher time frame candle, is it's going to open, low, high, and then close. And then once we understand, what's happening at the delivery of, these different reference points, that's what's going to help us, be able to better find potential trading opportunities or even develop potential systems that we can trade. All right, so that's that anatomy of a candlestick, but we'll talk about this more when we talk about the power of three and the weekly and daily range expansions at the last slide of the call. All right, so let's move on to the next one. All right, so the base principles of liquidity is going to be this next chapter. So this is the market efficiency paradigm. So what the market is essentially doing is it's going from liquidity to liquidity. And then as it's moving from liquidity to liquidity, it's rebalancing or it's, going to negate that imbalance, right? So when we rebalance, so let's say that we have a range like this. Here's that inefficiency within that range or that imbalance within that range. And then we go back into it. And then after we rebalance, we should want to go back towards the stops because as ICT says, reaching for liquidity is institutional market structure 101 and institutional market structure 201 is that imbalance, right? So when we rebalance that imbalance, we're going to go for those stops. And then this is attributed to a trending market. So when we have stops over here, here's that imbalance, and then we negate it. When we negate this imbalance, that's indicative of us wanting to go for those opposing stops, right? So Here is that opposing stop. So let's say that we had.
You okay now? Okay.
Yeah. Did you have a question? All right. Well, anyways, so over here we just took out liquidity, and then after we take out that sell side liquidity, we need to rebalance that range. And then if we negate that imbalance, there's a high chance that we're going to be going for these opposing stops. So when we negate that, we'll see something like this. And then when we trade stops to stops, that's indicative of us wanting to reverse. So everything that we're going to talk about, everything that is, in line with algorithmic theory is going to be based upon this principle right over here, right? So I talked about the subtle nuance of language, and the reason that price seeks imbalance is because its intention is to efficiently deliver price, right? So we talked about how the financial markets need to be efficiently delivered, because if they weren't efficiently delivered, then we would have chaos in the streets every single day, because the entire backbone of economies is based upon the efficiency of the financial system, essentially. So the financial system needs to be efficiently delivered. And then since we understand that ICT concepts are, the true underpinnings of the market, or at least that's what we subscribe to, we also look at ICT concepts as having a sort of efficiency in their language, right? So we know that price is going for liquidity, and that's institutional market structure 101. And then institutional market structure 201 is the imbalance. But why is price interested in the imbalance? Well, it's because price wants to be efficiently delivered. And then if it wants to be efficiently delivered, it needs to rebalance those imbalances. And we'll take a deeper dive into efficiency in the later parts of this lecture as well. All right, so balanced price ranges. So balanced price ranges are areas of price where both buy side and sell side liquidity has been equally distributed. So I know that, people talk about those overlapping fair value gaps as balanced price ranges. And yes, that is true. But today I'm more so focused on, when we have a range of price where both buy side and sell side liquidity is being evenly distributed. So something like this would be a balanced price range, and something like this where we trade both buy side and sell side is also a balanced price range. So this is more so what I'm focused on. But if you can understand the logic behind why we call these balanced price ranges, you'll also understand why, this formation over here is also a balanced price range. All right, so that's just a brief introduction into that, but we'll talk a lot more about this in the upcoming slides. All right, so what I have here is a 6-month chart of the euro dollar. And before I explain this, let me tell you guys a story about somebody that I met a few years ago. So basically, this guy, he created algorithms for companies that trade forex, and he sold the rights to those programs or those algorithms to these companies. And I was at a coffee shop one day, and he was trading, or he was, I guess, testing some type of software that he was developing. And then I just got into a conversation with him. But one of the main takeaways that I got from that conversation was how he was telling me that over the course of time, where the euro dollar was publicly being traded, there was a somewhat even distribution of up close days and down close days. Now, at the time, I didn't fully realize the importance of that. But now that, I've gotten a lot deeper into ICT, and I understand that the goal of the markets is to be efficiently traded, this makes a lot more sense. So right here, here's that data from Euro USD. So this is since, I guess, 1986. I'm not exactly sure the exact time where the Euro USD was allowed to be publicly traded, but I know that it was somewhere around there. But let's take a look at what's happening here. This is efficiently traded, right? We understand that all the buy side and sell side within this area on this larger time frame, this 6-month, has been efficiently traded, right? Notice how buy side, sell side, buy side, sell side. has been evenly offered, right? So this entire range is pretty much balanced. And that goes perfectly in line with what he was telling me about how there was an even distribution of both, up close and down close days. And, if we are to kind of interpret ICT's words, he says that, the markets want to be efficiently traded. That's why the markets, when they seek liquidity, that's when they create imbalances. But because the market wants to be efficiently traded or efficiently delivered, that's why it's going to want to efficiently deliver or rebalance those inefficiencies. So you can see just, that understanding of liquidity and imbalance being shown here, right? And this is on a 6-month chart, right? So ever since that Euro USD data was available for this, you can see that everything has been evenly matched up. So another way of interpreting this is that what you're trading, like when you're trading intraday, when you're trading, your weekly profile or whatever, all you're doing is that you're just trading one fractal of something that is efficiently delivered or something that's going to be efficiently delivered, right? So that's another deeper way of us looking at this. All right, so let's move on into the next slide. All right, so fair value. So now that we understand balanced price ranges, let's talk about fair value. So let's say that we have a range of price where both buy side and sell side delivery were evenly offered. So let's say that we're going higher, then we come lower. This right here is a balanced price range, right? So we have a balanced price range, but price isn't just going to be consolidating forever because price is going to seek liquidity and it's going to want to rebalance and balance. Right now, everything is efficiently delivered. So there's no imbalance, right? If something is efficiently delivered, there's no imbalance. So therefore, it's going to seek liquidity, right? So let's say that liquidity is over here, right? It does a deep run of these stops over here. Now what's being traded or what's happening over here in the market? Well, we have both buy side and sell side delivery evenly matched up, right? So this was that efficiently delivered range. And then the last point where we were efficiently traded to was this point right here, right? So that's what we call our level of fair value, right? So the market wants to be efficiently delivered. So this pink range right here is efficiently delivered. But over here, we are inefficiently delivered because we're only offering sell side delivery, right? So the market is inefficient at this level. So what needs to happen, or what the market is going to seek to do, is it's going to want to come higher, at least to this point right here, because this is where we are inefficient until. So this level of fair value is that last place where that buy side delivery was offered, because we came from here all the way up to here with buy side delivery, and then we came through that level with only sell side delivery, right? So that's why we need to offer more buy side delivery up until here, and we need to rebalance the range, right? So we just took out liquidity over here. Let's make that a blue color again. So we just took out liquidity here. The imbalance is at this point right here. So price needs to go rebalance. And then now that price is efficiently delivered or it's completely balanced, it's free to seek liquidity again. Now, whether price wants to go higher and seek this liquidity or this liquidity, we won't know until, we see how price responds at this level. But from a conceptual standpoint, now that the range is efficiently delivered, its next job is to seek liquidity. All right, so that's that little bit of fair value. Was there any questions on this, by the way? I know that you guys are pretty familiar with this concept already, but just in case there was any lingering questions, you guys can unmute yourself and ask before I move on. All right, I'll move on then. All right, so the PD array matrix. So all the PD arrays can be interpreted through the lens of liquidity and inefficiency / efficiency. So we talked about how the markets, all they're doing is just offering, or seeking liquidity, or rebalancing imbalances because the market wants to be efficiently delivered, or the market seeks to be somewhat balanced. And that's literally the entire premise behind what ICT concepts are, because ICT is teaching you how the markets work, and the markets are literally just seeking liquidity and rebalancing or efficiently delivering the markets. Right. So anything that ICT talks about, any concept that he brings up is going to subscribe to that way of thinking. It's going to subscribe to that, that notion that the market is seeking liquidity and wanting to rebalance. Right. So every single PD array right here, that has to do with liquidity. Right. So every single PD array deals with liquidity or inefficiency slash efficiency as well. So that's why I have those terms, because when you're dealing with efficiency, you're also dealing with inefficiency as well, right? So that old high is just liquidity. This rejection block is just an imbalance or an inefficiency, right? So this bearish order block, we understand that a bearish or just any order block really is a balanced price range. So that's efficient. And we understand that there's two ways to leave a balanced price range. And in this case, we should want to leave with speed. So therefore, when we have a imbalance that accompanies a bearish order block or a bullish order block, that makes it a bit more logical for us to react off of. So we can put inefficiency here as well, because it is heightened in probability in the presence of an inefficiency. And then a fair value gap is just an inefficiency. Same thing with a liquidity void. A bearish breaker is just a balanced price range. Right, so that's efficiency. Hopefully I spelled that right. And then that's also heightened in probability when accompanied by a inefficiency, because one way to leave a balanced price range is with speed or with inefficiency. So when we have a breaker that forms and then we see displacement or speed that accompanies it, that's going to make it a little bit more logical or probable for us to want to react off of. All right, so that's, it's heightened in probability in the presence of an inefficiency. And same thing with this as well, right? A mitigation block is a balanced price range, right? So efficiency, and then same thing, it's a block PD array. So anytime we have a breaker block, order block, mitigation block, those things are going to be heightened in probability when they are accompanied by an inefficiency. And then we know that price changes its state of delivery at PD arrays. So when price is turning around, it's only ever going to turn around from these PD arrays, right? And then you can use the same logic that we talked about for the old highs and lows and rejection blocks for these discount PD arrays as well. All right, so that's that PD array matrix. Was there any questions on this before I go on? I'm gonna take a look at the chat as well. All right, doesn't look like I have any questions, so I'm going to move on. All right, so now let's talk about the intrabank dealing range. So the intrabank dealing range, all that is just a sweep of buy side and sell side liquidity. All right, so when we sweep both buy side and sell side liquidity, what's happening is we're creating a balanced price range. Right, so let me get rid of that, and then let me highlight where the balanced price range is. So we have buy side delivery, and then we have sell side delivery down into here. And then that creates a balanced price range. So when we have a balanced price range, we are efficient, right? So this area of price, this pink area of price is efficiently traded, right? So this area has both buy side and sell side, liquidity, or sorry, buy side and sell side delivery that's been offered at this level. And then the best dealing ranges are the ones that leave with speed, right? So the best way to leave a balanced price range, or the most high probable way for us to leave a balanced price range, is with speed. Because when we leave with speed, it's showing us that price is one directional, right? So it's headed in one direction. And then that creates this inefficiency, right? So when we create an inefficiency and we leave a balanced price range with speed, there's a high likelihood that price is going to want to come up into here to rebalance this, because remember, the market wants to be efficiently delivered. So it's going to come back up within that level. And then there's a chance that we should, then continue lower from there, right? So there's a few phases of a intrabank dealing range. So we have engineer, and then we neutralize, and then we distribute, and then we rebalance, and then we redeliver. All right, so we can call this phase 0, phase 1, 2, 3, and then 4. Right? So if we were to draw this in conceptually, we take out the high, we take out the low, right? So this was our engineering range, 1, 2, and then now we understand that this over here was that balanced price range. Here's that balanced price range over here. All right, so let me get rid of that and then just draw that in a pink box. So we have 1, 2, and then now that we're inefficient because we've only offered sell side delivery, we should want to rebalance the range to at least over here. And that's what this rebalancing phase does, right? So phase 3 is actually very logical. So I mentioned how the best dealing ranges leave with speed because that's what creates inefficiency. And then when we have inefficiency, there's a reason to rebalance, right? So that's why the best dealing ranges often leave with speed. And then we should want to rebalance at least up to here, right? We could go deeper, and that's okay as well. But phase 3 is going to form at least that neutralizing phase. And then from there, if we're still, have a bearish draw on liquidity, then we should want to come lower. And typically, or actually, this is a rule for a dealing range, is that phase 4 should want to take out phase 2. Because let's take a look at this from a logical standpoint. So let me get rid of that. So all of this is balanced, right? So if this area is balanced, then price shouldn't necessarily have any reason to want to take out this high. So when we come back up into a range that is already efficiently delivered, then it should then want to sell off from that area and then at least take this level out. Because over here, actually, yeah, so this area is balanced. Here's that level of fair value. And then this area should be that draw on liquidity because, we've already offered buy side, sell side. And then here's that sell side. And then we come back up to rebalance that range. Everything is good here. And then, we should want to continue lower, right? So that's that phase 1 or type 1 dealing range. There's also a type 2 dealing range. So if I were to draw something in like this, 1, 2, 3, and then 4 fails to take out 2, and instead it takes out 3. In this case, phase 1 would be that draw on liquidity. And typically what's going to happen over here is there's going to be an imbalance. So we talked about how the best dealing ranges should leave with speed. And then when we negate this imbalance, that's a sign that maybe we're going for the stops. So if you remember, I talked about at the start of this lecture, I talked about how, when we have an imbalance within that range, after we've taken out liquidity, if price isn't interested in turning around from this imbalance, then price is going to want to seek the stops, right? Because it's just interested in liquidity and imbalance. But if it's not interested in this inefficiency over here, then it's going to be interested in the stops, right? And this area is already efficient. So we expect for price to want to turn around from here, but if it's not turning around from, that inefficiency within this already efficient range, then that means that this high over here is probably what it's seeking, right? Because it's already efficiently delivered. So now it needs to seek the stops. Now, most likely in a type 1 dealing range, the stops are going to be here. But when a type 1 dealing range isn't printing, we know that the liquidity that it's actually interested in is going to be the buy stops above here. All right, so that's the two types of dealing ranges and the logic behind them. And then you can see this playing out right here. So let's interpret what's happening here through the lens of efficient delivery, fair value, and the intrabank dealing range, right? So we have sell side delivery, we have buy side delivery, right, all the way up to here. And then now we have sell side delivery over till here again. All right, so this is a picture perfect example because it stops right at that level. You know, there are going to be instances where obviously price comes a bit deeper, and that's okay as well because it's still working within that efficiently traded range. So, you know, any part of that range could really give us a change in the state of delivery. But the main point where the sensitivity should come in is at this high over here, right? So price comes down into there and then it trades higher, right? But what's happening as it's doing that? So as it's doing that, it sweeps sell side and then it sweeps buy side, right? So sell side, buy side has been delivered. And then now we get this new balanced price range, right? So we have sell side being matched up with buy side. And then the last place where we are inefficient until is over here. But notice how, you know, there's also a PD array in the form of that fair value gap that's a little bit deeper within this overall balanced price range. So price goes towards that, it respects it, and then, you know, it forms phase 3 over here. And then phase 3 is what leads us to take out that phase 2. All right, and this also forms another balanced price range. Right, so sell side, buy side, right? And then it's just that cycle all over and over and over again. Because as we saw from that much, much higher time frame, all the market is really wanting to do is efficiently deliver, right? So all the buy side and sell side, all the buy side and sell side delivery, you know, from whenever this market data was available, it showed us that everything was leaning towards being efficiently delivered because that is what the market seeks to do. All right, so that's that idea of the intrabank dealing range. We'll build on this idea a lot more in the subsequent parts of this as well. But one more thing that I want to say is that an intrabank dealing range is a high probability pricing sequence, right? And the reason for that is because there's a high probability that price shouldn't want to take this level out. And the reasons for that, you know, there's multiple reasons, but the fact that we have a balanced price range over here, the fact that we've just taken out liquidity, so the next thing that we need to do is rebalance, and then after we rebalance, we should want to, you know, continue higher, and also the fact that we have multiple PD arrays within this range over here make it high probability for us to want to, you know, reverse from when we rebalance this area. Right, so just think about how many PD arrays are within here. We have this fair value gap, we got this order block over here, we have this breaker, right? So that's already 3, and coupled with the fact that this is a balanced price range and everything else that I mentioned, that's what makes this such a high probability scenario when we see it happen in price. All right, and the market is always going to be within one of the phases of this high probability pricing sequence. So if you zoom out on your charts, the market will always be in some form or some phase of, you know, a certain time frame intrabank dealing range. All right, so I'm going to leave that, you know, for your studies, but let's move on into the next slide. Was there any questions on this, by the way? I think the newer guys might have some questions, but I know that you guys are veterans, but I still want to give you guys that time on the floor if you guys have anything to add or anything to ask. All right, I'll move on. All right, so right here, actually, before we take a look at this, let me talk about one more thing. So this intrabank dealing range is going to be a fractal phenomenon. So we can see this intrabank dealing range play out in the form of just a few candles as well. So let's say that we have a up close candle over here. We have another up close candle over here. And then we have a down close candle, something like this. Right here, we have an intrabank dealing range, right? So we take out buy side liquidity, sell side liquidity of this candle, and then, we take out this candle, or we take out the low with this candle right here. So that's one. This wick is going to be two. And then what we anticipate for the next candle to do is to do something like this. We open that upper wick, that manipulation phase goes up within that level, and then price then drops off from there, and then we get phase 4 right here. So this is phase 3, and then phase 4. All this is just an intrabank dealing range, and you'll see this play out in one of ICT's trades when we talk about it in the next slide. All right, so this is from ICT's 2022 mentorship. And the reason that I'm showing this is because ICT didn't teach the intrabank dealing range necessarily in his 2022 model, but I mentioned how ICT concepts are a language for, explaining how how the financial markets are efficiently delivered, right? So ICT concepts, we believe, are the true underpinnings of the market, and they explain, why the financial markets do what they do. So in order for it to explain something that is efficiently delivered, the language itself must be efficient and fluid, right? So what I mean by that is there's more than one way to be right when looking at ICT concepts. And generally, when you're right and when you're really right about a certain price move, you're oftentimes right in more ways than one. So within this, ICT just talked about his 2022 model, but I'm going to show you how, there's multiple ways of looking at this and still coming to the right conclusion, because that's how complete, ICT concepts really are. So his ICT 2022 model talks about taking out liquidity, going up above a short-term or intermediate-term high or low with the displacement, and that is your market structure shift. And then we rebalance that imbalance within that range. And then, we ride that continuation from that imbalance towards our target, right? So that's, in a nutshell, that model. But there's other ways of looking at this as well. So right here, all that's happening is an intrabank dealing range has formed. We sweep sell side, we sweep buy side, and then here's that imbalance, right? So as this is happening, there's also a different way of looking at this as well. So we just took out liquidity, and we understand the market is just interested in liquidity and imbalance. So we come back down inside of this imbalance here, and then we go higher, right? So there's those different concepts, but they still all blend together, right? And then if we want to outline the intrabank dealing range, 1, 2, 3, and then also, here's that breaker, that PD array matrix, and then here's that efficiently delivered price range, right? So you see all of these concepts working in unison, right? So when you're right about ICT concepts, or when you're right about something using ICT concepts, you're generally right in more ways than one, right? So that's that premise and that logic behind this trade. Now let's take a look at that intrabank dealing range, that fractal version of it, and how it can also apply within this range of price over here. So notice here how we sweep this candle's high, and then we sweep this candle's low over here, right? So that's phase 1, that's phase 2, and then we see an imbalance over here, and then price comes back up within that level, and then gives us phase 3, and then from there, we redeliver lower, and then that gives us our phase 4, right? So we could say that this is phase 4, but you can see that intrabank dealing range is in play over here. Now, another way that we could have looked at it and still come to the same conclusion is the fact that we negated this imbalance, right? So when we negate this imbalance, we know that that's a sign that maybe we're going for those opposing stops, right? So either way that you look at it, it still supports that same, that same idea in that particular direction. And that's just the beauty of ICT concepts. You can look at it, through the lens of different concepts, but you can still come to the same conclusion. All right, so let's move on into the next slide. All right, so let's talk about the only two signatures in price. All right, so this is referring to swing points. And as traders, we are interested at areas where price is turning around. And those areas that offer the best opportunities, or those are the areas that offer the best opportunities. And when price is turning around, it will do so with two signatures. And those are the breaker and the failure swing. All right, so I have just from a random video from ICT, you can see that these concepts still hold. So notice how we have that failure swing here, and this is a turning point in price. Notice how we have a breaker over here, and that's a turning point in price. And same thing over here, right? Turning point in price, and just any other turning point in price, you're going to see these characteristics. All right, so let's take a look at the breaker and the failure swing in a lot more detail. All right, so the failure swing. So the failure swing is associated with the mitigation block PD array, and a high probability failure swing will take out liquidity prior to the formation of the mitigation block, right? So let's talk about this, right? So this is the part that confuses a lot of people. So when we have something like this would be an example of a high probability failure swing, right? So we take out liquidity. So there's not necessarily a need for us to take out liquidity again. But the reason that this is, so that's the reason that makes it high probability. And then a key point here is that we take out liquidity prior to the formation of the mitigation block. So when we form that mitigation block, that is when this failure swing is really cemented, right? So this is not a failure swing until we trade below this low. And at that low, we're going to have a down close candle, right? A last down close candle that is going to be our mitigation block. And then once we trade through this candle's low, that is when that mitigation block is really cemented in price, right? So, and then price comes lower through that area, and then that's when this failure swing is cemented, right? So if we have just a scenario like this, that's not necessarily a high probability failure swing. But when we have something like this, where we take out liquidity, and then, we, create that mitigation block, that's when this would be a higher probability failure swing. And we'll take a look at a example of this when we look at the market maker models. I have a example of that. But as price is trading lower through this area, we create a breaker here as well. But this breaker isn't necessarily created until after we come past this level. So that's why in this case, this would be turning around via a failure swing. All right. And then so we talked about the mitigation block and how that forms, and then how the failure swing correlates with that. All right. So if there's no questions, I'm going to move on into the next slide. All right, so that's one way that price turns around. Now let's take a look at the other way. So the next way that price turns around is via the breaker, right? So this is straight from ICT himself. So ICT says that this breaker, or this pattern of the breaker, is, in my opinion, is the most powerful, the most dynamic, the most significant price pattern that you need to learn conceptually. And he talks about this in month 5, of defining institutional swing points. And you can find this exact quote at that 3-minute mark, right? So when ICT talks so highly about a concept, we need to really see why that is. Because remember, ICT knows a lot more than us. So when he praises a concept like this, we really need to uncover what's happening behind, the logic of this concept. So let's try to uncover why a breaker is so important, right? So what is a breaker? How does a breaker form, right? So we understand that a breaker has a high, a higher high, and then we trade past that low. So we already took a look at this formation in the past couple of slides, and we understand that all this is just a dealing range, right? It's just an intrabank dealing range, right? So a breaker is a intrabank dealing range, and we understand that an intrabank dealing range is a high probability pricing sequence. And we understand that since a breaker is a type of dealing range, and since a interbank dealing range is a high probability pricing sequence, that means, we can deductively, infer that this is also a high probability pricing sequence. And that is why ICT talks so highly about this particular formation of price, right? Because a breaker is also a high probability pricing sequence. Why is it a high probability pricing sequence? Well, we talked about this earlier, but let's talk about it again. Right here, we have buy side delivery. Let me denote that with a blue color, right? So this is buy side delivery. We have sell side delivery, right? And then we talked about earlier when we were talking about PD arrays that a good breaker should be accompanied by speed, right? Or one-sided delivery through that area. So when we're forming a bearish breaker, it's going to be that last down close candle prior to this higher high forming. And then once we trade past this level, that's when that breaker is validated, right? So we can call that breaker validation, whatever, right? So when we trade past that area, we should want to trade past it with speed. Why should we want to trade past it with speed? Because of this balanced price range. And the best way to leave a balanced price range is with speed, right? Because when we leave with speed, we create inefficiency. And then the algorithm wants to be efficiently traded. So that becomes a high probable area for price to rebalance. So that's a potential rebalancing area, right? So price should want to come back up into that area. And then we know that since price has already has already efficiently traded this level, it's not as probable for price to want to come back up into here, unless, the true intention of the market is to go higher, but unless that's the case, then price should want to come and take at least this level out over here, right? So that is why, or at least that's one of the reasons, or one of the many reasons why ICT praises this concept so much. And on top of that, we have that low being taken, right? We talked about this in that trade example from ICT, right? So that's liquidity. After we take out liquidity, price's intention is to rebalance, right? So it rebalances that area. And then we ideally want to see a fair value gap within this area, right? And then it should want to come back up within there. And then maybe price, drops off from there, right? So that's that significance of a breaker, right? So we talked about how a breaker is a turning point in price, right? And we talked about how a breaker is also that high probability pricing sequence, right? So we ideally want to see a breaker when we're turning around, right? So when price comes up within an array and then it starts, potentially giving us a high probability pricing sequence, then that's a sign that maybe price is wanting to turn around. And that's kind of one of the premises behind ICT's 2022 model, right? So when we're trading that, literally we're just waiting for price to want to come up into an array, right? So here's that PD array. And we understand that price is only going to want to turn around from a PD array. And then we come back up within this level. We take out buy side liquidity in this case, since this is a bearish example, right? So the first thing that ICT talks about in his 2022 model is that buy side liquidity sweep, or just that liquidity sweep. right? So we have buy side liquidity taken, and then this low right here is your market structure shift. And we already talked about when we, have a breaker, we want to see that level get traded through with speed. So that's why ICT talks about displacement, right? So that's displacement. And then we understand why price should want to rebalance this area. Let me draw that in a different color. So let's say that we have this fair value gap over here, and then price should want to rebalance that area, come back up, and then, according to ICT's model, you could take your entry from there and then maybe come lower, right? So that's this idea of that institutional swing point and how it could potentially blend with, one of the models that ICT has already given, right? And especially when it forms at a PD array, that there's a good chance that maybe, price is going to use that level to potentially, want to turn around from, because you have that ICT 2022 model, you have a breaker, which, ICT praises so much, right? And then price comes back up within that breaker. And we already talked about the logic behind this delivery over here, right? And why it's so powerful. And then that should potentially give you a high probability reason for it to want to drop lower from, in this bearish example, right? And then just to complete our understanding, this would be that sell side sweep, right? So sell side liquidity sweep, and then that would cement your intrabank dealing range, right? So you could use this concept in conjunction with that ICT 2022 model as well. All right, so that's everything for this slide. Was there any questions for the guys from the call? All right, I'm going to move on then. All right, let me let Nasri in. All right, so now that we're done talking about the breaker, let's move on to the next slide. All right, so the significance of a swing high or a swing low. So when price is turning around with the high probability swing points, so the reason that I say high probability swing points is because, I want to include the high probability failure swing. So we already understand that a breaker already is high probability, but the reason that I included, this vocabulary is, for, the people that want to trade a failure swing. And, I was trying to highlight that you should, most likely gravitate towards the higher probability failure swings. So when we're turning around with the high probability swing points, it will do so via a short-term higher low, intermediate term higher low, and a short-term higher low fractal. And just about every time price turns around, we see a fractal of this phenomenon. So anytime a high forms in the marketplace, it's going to form like this, right? So actually, let's make all these green candles. So anytime a high forms in the marketplace, it's going to form like this. So all this is just a short term, right? A short term high, an intermediate term high, and another short term high, right? So that's one example of it. And this is the most fractal version of it. And we call this a swing high. But one other way that it can happen is also like this, right? So when we have our dealing range, a dealing range is nothing more than just a short-term high, an intermediate term high, and a short-term high, right? So that's another reason why we consider that a high probability pricing sequence, because it has the signatures of price wanting to turn around, right? And that's another reason why a breaker is so powerful, right? Because for this reason here, short term, intermediate, short term. And we understand the logic behind what's happening as these swing points are forming, right? So let me reiterate this again. That way we can blend, that knowledge of dealing ranges and breakers with the short term, intermediate, and short term. We have a balanced price range, right? So we sweep liquidity as well. And then we trade through that area. Yeah. So that gives us short term, intermediate, and then there's a logic for why this short-term low should form. right? Because, we already talked about it. This is efficiently delivered, right? So price shouldn't want to come back up into there. And then, this is a level of fair value. So when price hits this level, it should form a high and then trade lower, right? And then at this short-term high, we're going to see this phenomenon. We're going to see a swing high form at this area, right? So here we're going to see something like this. And just like this right here. And all this is just a dealing range. All this is just a really, really fractal breaker, right? So right here, what's happening is that price trades buy side, right? It takes out that buy side liquidity pool. It takes out that sell side liquidity pool. It comes back up and then it drops, right? So that's why when this fourth candle forms, there's that high likelihood that price should want to come lower. And the reason for that is because all this is just a dealing range. All of this area over here is efficiently delivered. So once price forms that wick, it has like really no reason to go back above that high if that draw on liquidity is lower. So price should hit that level and then it should want to come lower from that area, because all a swing high is, it's just, it's just built upon that framework of an intrabank dealing range at a very fractal level, right? Because if we were to draw all of this in, right? So here's that open, low, high of that first candle, right? And then, we go higher from here, then we close, right? So engineer, neutralize, and then we take out that. So that's buy side, sell side, and then this fourth candle rebalances this already efficient range, and then we should want to see it drop, right? So that's the logic behind the swing points. And now you can see, the logic of the intrabank dealing range being used as they are forming. All right, so I'm going to move on to the next slide. All right, so now let's combine all that understanding with the market maker models and the buy and the sell programs. All right, so that's going to be the next chapter. All right, so what do we know about market maker models? Well, market maker models form within defined ranges. Market maker buy model is nothing more than price going lower to then go higher. A market maker sell model is price going higher to then come lower. And then a market maker model doesn't have to complete. And in a bullish market, market maker buy models will complete and market maker sell models won't tend to complete. And in bearish markets, market maker sell models will complete and market maker buy models won't tend to complete. All right, so in the upcoming slides of this chapter, we're going to uncover what all of this really means. So let's move on. All right, so a market maker buy model. So when a market maker buy model is forming, the algorithm will start the delivery from the original consolidation and will eventually drive into a key level or a PD array, and then it will change its state of delivery. So that's called that smart money reversal. And then from this change in the state of delivery, we will see price run higher. And in bullish markets, the retracements are just the sell side of the curve, and the expansions are just the buy side of the curve, right? So let's build this upon that framework of a trending market. So we understand that we have a trending market over here, and then we already defined the characteristics of a trending market. So a trending market is going to trade stops to imbalances, or from liquidity to inefficiency, right? So we have inefficiency here, inefficiency here, inefficiency here, right? Now, all that's happening here is market maker models are forming. So we loosely defined a market maker buy model as nothing more than price going lower to then go higher. And we defined a market maker sell model as price going higher to then come lower, right? So here, as the market is trending, or as the market is trending lower, it's going higher to then come lower, right? So this right here is a market maker sell model. And then, obviously we have these different characteristics within the formation of these market maker models. But let's just understand the delivery behind them first, right? So within this, there's also a market maker buy model, right? So we talked about how in a bearish market environment, the market maker buy models, they won't tend to complete. And the reason for that, so a market maker buy model is price coming lower to come higher, right? So it comes higher. But why does price stop here in this diagram? Well, the reason for that is because this area is already efficiently traded to, it's efficiently delivered, and the draw on liquidity is lower, right? So price's intention is to go lower because we're in a bearish market. So price wants to come lower, and it's already efficiently traded through this range. It's traded both buy side and we've traded sell side through that area. So there's really no need for it to come any higher than this. That's why this market maker model doesn't have to complete, right? So remember, the goal of the market is to efficiently deliver price. That's why institutional market structure 201 is the imbalance, right? So the imbalance is created as we're trading to liquidity, and we seek to rebalance the imbalance because we want to be efficiently trading. What was that? Sorry, so I'm just reading the chat real quick. So Nasri was saying from the drawing, the incomplete market maker buy model is a half market maker sell model. Well, these market maker models, they formed within, these defined ranges, right? And we're overall bearish. So there's no reason for us to, want to come higher here because this is our draw on liquidity and this area is already efficient, right? So the job of price coming higher is just to efficiently deliver price. And it needs to efficiently deliver up to this red line over here, right? So there's no reason for it to come higher. That's why it'll stop here and then it'll trade lower. But as it's going higher, it's doing so with the intention to come lower because that draw on liquidity is lower in price, right? So we're in a bearish environment, right? So we need to trend lower. So bearish means that we're trending lower. And then when we're trending lower, we're trading from stops to inefficiencies, right? And then a market maker sell model is nothing more than price just going higher to come lower. And we understand that price changes its state of delivery from PD arrays and only PD arrays, right? So this inefficiency here, which correlates with this one over here, is that PD array. So price comes up into that PD array of this already efficient range, and then it will, look to change its state of delivery and then trade lower from there. And that's what creates this market maker sell model, right? We have buy side delivery, and then we have sell side delivery. And as we're going lower, same thing happens, right? In a trending market, now that buy side and sell side delivery, has been matched up, we are inefficient up to here. So literally all a market maker model is it's a balanced price range, right? So every time a market maker model completes, we're forming a balanced price range. And when a market maker model doesn't complete, it's probably because we've hit a area where, we're already balanced until, so we don't necessarily need to, trade past that level. That's why when we're bearish, we just, trade to fair value on the buy side of the curve, and then we trade lower. And then in this example that I'm drawing out, we trade lower past that area, and we understand that this area right here, because it's a completed market maker model, it's, it can also be defined as a balanced price range, right? So completed market maker model, MMXM, so a completed market maker model is the same thing as a balanced price range, right? Buy side and sell side delivery have been efficiently offered. And one of the ways, or the best way to leave a balanced price range is with speed. And because we're bearish, we should want to leave with speed, and then we should want to come back up and rebalance, and then we keep going lower until our draw on liquidity is met, right? So that's how these market maker models form, within the context of a trending market. All right, so is there any questions on that, guys? All right, I'll move on. All right, so here's that example. This is that market maker buy model. So notice how we were inefficient till here. We hit that level, and then we start offering buy-side delivery to take out that original consolidation. Right, so in this example, we're not necessarily going to look at the reaccumulations and redistribution levels, but just understand how price is delivering and how this is a market maker buy model, right? And then look, so after we trade both buy side and sell side of this area becomes efficient, right? So this area becomes efficient. And then if we come back within this area, our first anticipation is that maybe this area is going to allow for price to then want to take that level out. But if it doesn't, then we understand that price should want to come down into here, because after it's done rebalancing, its job is to take liquidity, right? So, and then there's liquidity here and liquidity here, right? And we talked about that concept at the start of this lecture. So let's move on into the market maker sell model. So I'll just briefly go over, or actually, Alec already went over it. I guess I talked about market maker sell models on the buy model. So I guess I'll just talk about buy models here then. I kind of messed up my order, but same thing's happening here. Price is just trading stops to inefficiencies, right? So here's that inefficiency or that PD array, but also this balanced price range, right? So when price is coming lower, it's coming down within that balanced price range, right? Notice how price is offering sell side and buy side of that area, and then price comes lower, it hits that area, and then it finds a PD array within that balanced price range, and then that facilitates for higher prices. But as price is coming lower, it's on that sell side of the curve, and then as price is going higher, it's on that buy side of the curve. And then after it trades past this level, it creates a new balanced price range. And if we're still bullish, then chances are that we should see price leave this range with speed to the upside. Because when we leave with speed, we create a level of fair value or inefficient price action. And when we have inefficient price action, we should want to efficiently trade to it. So we need to rebalance that area, right? So that is going to give us another market maker buy model, right? So price comes down, and then we hit that level. Maybe in this case, we even come lower. And then from there, that'll give us a potential buy side of the curve until we hit this array that's up here, right? So that's how price is going to deliver in that trending manner. And that would be that market maker buy model. So we talked about sell models, or I gave that example of a sell model earlier. So that's why I'm giving that example of a buy model here. All right, so let's move on into the next slide. All right, and here is that example of a market maker sell model. So price hits a array. So we had the remainder of a weekly imbalance, and then that previous week's high. So that's so we take out both of those PD arrays, or we hit both of those PD arrays, and that's where that smart money reversal comes in, and then price comes lower, right? And then we do take out that level right here. It's not very clean in this example, but we still take it out. And this is that example from this week. And then if you guys remember, I talked about how I had an example of a mitigation block or a high probability failure swing. So right here, we take out liquidity, right? So there's the high and that high over here, but there's not necessarily a swing low over here that we trade through. So there's no breaker, but there is a mitigation block, right? So a high, lower high, and then here's that low over here. So basically what's happening is this formation right here, but we have, some liquidity from around here. And then, we take out, whoops, let me draw that in a bit better. All right, so here's that mitigation block over here. We take out that liquidity. We don't necessarily have a breaker here, but we do have that mitigation block. So we have this high probability failure swing. And then notice how this delivery of these candles, the bodies respect this mitigation block over here, and then price then comes lower, right? So we never come back above this level, and then now we've traded and completed this market maker sell model. So you can see that blending of all those different confluences, or all those different ideas of the swing points, the market maker models, liquidity and inefficiency, all within this, right? And then all this is doing is it's just creating a balanced price range. So we talked about how the goal of the market is to efficiently deliver price, right? So buy side and sell side needs to be offered. And that's literally the entire premise behind a market maker model, is to show you how price efficiently delivers buy side and sell side, right? So that's why there's a buy side and a sell side of the curve, because the goal of price is to efficiently deliver price, right? So it's to be efficiently delivered. So there needs to be a buy side and there needs to be a sell side, right? Because if you only have one, you're imbalanced or you're inefficient, right? So that's that deeper look inside a market maker model, or that extra theory. All right, so I'm going to move on to the next slide. All right, so order flow. So order flow is a measure of whether we are bullish or bearish. And when we are bullish, we want to see bullish PD arrays and down close candles supporting price. And we also want to see bearish PD arrays and up close candles being negated. And when we are bearish, we want to see bearish PD arrays and up close candles supporting price. And we also want to see bullish PD arrays and down close candles being negated. All right, and there's only ever the buy side or the sell side of the curve, because the algorithm runs on buy and sell programs, because it wants to efficiently offer, buy side and sell side liquidity. So that's why it runs on buy and sell programs. And then order flow is a means by which we can tell which side of the market maker model curve we are on. So over here, this was that buy side of the curve. This was that sell side of the curve. On the buy side of the curve, we see these down close candles supporting price, because price is interested in, offering or taking out buy side liquidity. And then after, price reaches a level where, sufficient buy side liquidity has been taken, it's then going to want to seek sell side liquidity. And then these up close candles are going to start supporting price until it meets its target, which is going to be a PD array, right? So that's, the importance of order flow and the meaning behind it, right? And then with order flow, you can tell which side we are trending towards. So when we have bearish order flow, we're trending lower, right? So we rebalance the imbalances, and then we take out the sell side liquidity, right? And then when we have bullish order flow, we rebalance the imbalances, and then we trend towards those buy side liquidity pools. So just a extra blending of the different things that we talked about here as well. All right, so I'm going to move on to the next slide. All right, so here's a deeper insight. So the market wants to be efficiently delivered, and the market hunts liquidity. And as the market is hunting liquidity, it will create imbalance, and it will rebalance those imbalances, because the market seeks to be efficiently delivered, right? So the formation of a market maker model is a creation of a balanced price range. So I'm saying this again to lay the framework for something a bit deeper. So let's move on to the next slide. So right here, right? So this should be a pretty eye-opening moment for just about everybody. So if you guys remember earlier, when I was talking about the PD array matrix, I was talking about how all the PD arrays are just a reflection of either liquidity or inefficiency / efficiency, right? So the order block is just a balanced price range, right? So let me draw that in. All right, so here's that order block. All right, so I'm just drawing in one candle, but there's multiple here, but just understand the logic. Right, so there's a few important pieces behind an order block. right? So it's that last, series of up close candles or up close candle prior to a move lower. But a order block is not an order block, or a bearish order block is not a bearish order block until the low of that area gets traded through, right? So this is what we call that change in the state of delivery, or we call that order block validation, right? So this is where that order block gets created, right? And all an order block is just a balanced price range. So when price trades buy side and then price trades sell side, it's creating a balanced price range. Now, we know that a high probability order block is accompanied by inefficiency. But why is that? Well, the reason for that is because the best way to leave a balanced price range is with speed, right? So we have a balanced price range here, and then we leave that area with speed, right? And then when we leave with speed, that creates inefficiency, and then the market seeks to be efficiently traded. So price should want to come back up into that level and then potentially offer, those continuations lower using that logic, right? So that's that significance behind that. Now, we also talk about how it's better for, that CSD to happen with a candle closure. Now, the reason for that is because when a order block is forming and we validate it with a wick, what's happening is, there's already buy side delivery here, and it's not leaving a balanced price range with speed, right? So let's say that we have something like this. So when this happens, we're not necessarily leaving that balanced price range with speed, right? So that makes it a little bit less probable for us to, see those expansions from that level. Now we could still see them, but this would be a much better scenario for the logic that I gave you here, right? So at the start of this call, I talked about how understanding the language that's used within ICT concepts will help you have, a better understanding of them. And that's the purpose of this slide over here. All right, so we talked about a lot of things being balanced price ranges, right? So we talked about how a market maker model is a balanced price range, and we talked about how a order block is a balanced price range. So if those two things are both balanced price ranges, does that also mean that the formation of an order block can be seen through the lens of a market maker model? Well, let's see. So I have this area highlighted over here, right? So there's buy side, and then there's sell side delivery, right? Now let's take a look at what's happening, within this delivery on a lower time frame. Look at that, right? Here's your original consolidation, reaccumulation, smart money reversal, right? Smart money reversal, redistribution, and then price comes lower, right? So that formation of an order block is literally just a market maker model, right? And then notice how price comes back up into this area, and then from there, maybe it sells off, right? Because all of this is just a balanced price range, right? Because that's the goal of the market, right? So regardless of what ICT concept you want to throw, it's literally just pointing back to the fact that the market wants to be efficiently traded, right? And then when it's hunting liquidity, it's going to create imbalance, and then it's going to come back to rebalance those imbalances to be efficiently delivered. And there's so many layers that you can build upon just that simple understanding, right? And then if you are good at playing with the language that ICT uses, you can, be able to connect so many dots, and then have all these aha moments, right? So this order block was nothing more than just a market maker model. And we understand that when we're bearish, price should want to come back up into these market maker models or balanced price ranges or last points where we were efficiently traded to, and then maybe, we trade lower from there because, maybe this is a sign that we've started to trend lower, right? So we have a market maker model that's completed. We have this market maker model that's completed. Now we should want to come back up into here, and then maybe we start going lower again, right? So you can see how all of these different ideas blend together. All right, so just a bit of deeper insight that I wanted to give you guys. All right, so let's briefly talk about some other concepts like the power of three, the weekly range, and the daily range expansion. So literally all this is, and this is going to be the final slide for today. So the power of three is just accumulation, manipulation, and distribution, right? So when a candle forms, we accumulate, we manipulate, right? So accumulation, manipulation, and distribution, right? So we accumulate around that open, and then we manipulate lower, right? So this manipulation phase forms that low of the day or the low of this candle, and then that distribution phase, trades higher, right? So this is that distribution phase, right? And then same thing for a up close candle, or I guess that was an up close candle. So let's make this green. And then for a down close candle, you're going to see something like this, right? So we accumulate around that opening price, accumulate, and then we manipulate, and then we distribute to the downside, right? So that's the formation of this down close candle. Now, what's happening at this stage is that price is changing its state of delivery, right? And we understand that that only happens at a PD array. So what's happening? So let's say that this is a daily candle. So what's going to happen is that this daily candle is going to open around here, right? It's going to play around in that opening range, and then it's going to drop lower into a PD array, and then it's going to change its state of delivery from there, and then it's going to trade higher, right? And this is assuming that that draw on liquidity is higher, right? And then same thing over here, right? So we understand that in a trending environment, the market is going to want to trade stops to inefficiencies, right? So on this day, this is how this next candle could form. So this is important since we're day traders, or the vast majority of us are intraday traders. So we wait for price to accumulate here. We wait for price to hit that PD array in that manipulation phase, and then that's going to give us a change in the state of delivery, right? And the best opportunities form at the change in the state of delivery. That's a quote from ICT, right? That's where the best opportunities are formed. And we understand just how price turns around, right? So I give you that one slide towards the start of the call where I said that as traders, we're interested in the turning points in price because that's where the best opportunities are formed, right? So we have this manipulation phase over here, and that manipulation phase is to create the high or the low of a particular candle. And since we're intraday traders, in this case, it would be the high of this daily candle. And then we could capitalize on that because that's a turning point. And then from there, we could ride that move lower in line with this order flow, right? So that's that significance behind this AMD model, or, that understanding of how a candlestick forms. So at the start of the call, I started off by, drawing in that anatomy of a candlestick, but now we understand just how price wants to deliver. And then I said a key point at that start of the call where I said that a candle is not a candle without delivery, right? And then in between that slide and this slide, we talked about how price delivers and how price seeks to be efficiently traded, right? And then we talked about all those different signatures that price can go through, or all those different scenarios that price goes through in order to make sure that it is efficiently traded. right? And then this is how you could potentially apply it into a trading plan, right? So that's that accumulation, manipulation, distribution. And then this is how it applies to a daily or a weekly range expansion, right? So this daily candle that we talked about could also be a weekly candle, and that logic is still going to be the same, right? So I believe that's just about everything for this. So for the guys that are going to be watching this on YouTube, I'll talk to you guys in the next video. And then for those of you guys that are on this call, we'll take everything off record.